Welcome to today's episode of Heard and Seen Around. I am Rajesh Karipurath. This is my take on macroeconomic and geoeconomic data points which I find interesting. I hope you enjoy watching it as much as I enjoyed curating it. Cheers.
Being powerful is like being a lady. If you have to tell people you are, you aren't. Margaret Thatcher. I have opinions of my own, strong opinions, but I don't always agree with them. George H.W. Bush. Politics is supposed to be the second oldest profession. I have come to realize that it bears a very close resemblance to the first. Ronald Reagan. Money talks. Mine usually says goodbye. The reward for good work is more work.
Here is a reality check. The economist argues that AI could be as transformative as electricity or the steam engine, but only if governments don't regulate it into irrelevance. The editorial warns that fear-driven policies could choke innovation, slow productivity, delay medical breakthroughs, and even hand the AI leadership race to China. History backs the concern. More than 2 centuries after the Industrial Revolution, very few countries ever caught the early movers. Turns out, in technology, pressing the brakes too hard can leave you watching everyone else disappear over the horizon. Well, here's a market that clearly did not get the cheap oil memo. Despite the sharp drop in crude prices, Bloomberg's overnight index swaps still price in around 1.5 Fed rate hikes by mid-2027, with a 34% chance of a hike in July and over 50% by September. Some Fed watchers have gone even further, calling for 3 hikes. But the counter-argument is compelling. Easing inflation, improving supply conditions, and a potentially more forward-looking Fed could mean no hikes at all this year. That is my opinion. Sometimes markets don't just climb walls of worry, they build entire staircases. As Keynes said, when the facts change, I change my mind. What do you do? Money is knocking on the exit door. The Financial Times highlights a sharp rise in redemption requests across major private credit firms, with Apollo and Cliffwater seeing requests climb to nearly 17% of fund NAV in the second quarter of 2026, while others like Blackstone and HPS are also facing steadily rising withdrawals. To be fair, investors often request more than they expect to receive, much like IPOs or bond deals, where everyone asks for extra allocations. Even so, this is a trend that the industry won't want lingering. Liquidity is easy to admire until everyone wants it on the same day. Here's a number worth pausing for. China holds a staggering $3.41 trillion in foreign exchange reserves, while Japan sits on $1.26 trillion. India ranks 5th globally with $543 billion. Much of Asia's reserve mountain is a legacy of decades of export surpluses and lessons learned from the 1997 Asian financial crisis. Here's where the story gets interesting. Many central banks are quietly diversifying into gold. Why? No issuer, no counterparty, and no sanctions risk. Gold isn't replacing the dollar, but is increasingly becoming the world's favorite insurance policy. Sometimes the quietest trade ends up making the loudest statements. As JP Morgan said, gold is money, everything else is credit. Not every soft patch is the start of a recession. This data suggests India's higher oil import bill is being driven more by prices than volumes, while auto fuel consumption remains resilient. There are signs of moderation though. Airport passenger traffic has slipped to around -5% year-on-year. FASTag collection growth has eased from nearly 17% to about 9%, and GST growth has slowed to roughly 2 to 3%. Yet India's external balance remains a strength, with external debt below 20% of GDP and FCNRB balances rebounding above $30 billion. Think of it as the economy shifting down a gear, but not pulling over to the side of the road. Gold has been losing its sparkle, and one big reason could be the US bond market. Since Kevin Bosch's nomination as Fed chair, the Treasury yield curve has bear flattened, with the 2-year yield jumping up from 3.47% to 4.14%, while the 30-year yield has barely moved to 4.85%. That typically signals tighter liquidity and has helped push the US dollar index above 101, a 52-week high. The stronger dollar has coincided with gold sliding from $4,865 an ounce to below $4,000. If tighter liquidity persists, pressure could spread beyond gold to Bitcoin and even equities. Sometimes gold does not lose its shine, it just runs into a stronger dollar.